Hi guys, I'm Chad Larson, Senior Portfolio Manager with MLD Wealth. Today is to talk about MLD ALPHA AI. I wanted to introduce today's session and the context behind it. This is a discussion about AI from an investment perspective, not about predicting the next application, platform, or headline, but focusing on understanding what must exist for AI to scale. This is a structural conversation, not a tactical trade. My goal here is today to frame the opportunity and to assess alignment. Generative AI adoption is accelerating across the economy. Platforms are embedding AI directly into enterprise and consumer workflows. This is no longer experimental or theoretical deployment. AI is becoming foundational to productivity, automation, and decision-making. What underpins all of this is that the adoption is about infrastructure. The global AI infrastructure market supports the entire AI ecosystem. That market is projected to grow from roughly $135 billion in 2024 to nearly $400 billion in 2030, driven by major capacity needs. The growth is not about guessing which application wins. It reflects the physical systems required to support intelligence at scale. Capital is following infrastructure because it must. Rather than betting on individual applications or technologies, this approach focuses on the picks and shovels of the AI cycle, the infrastructure that every AI development depends on. The AI revolution has entered its infrastructure and adoption phase. This is where capital spending becomes tangible. Data centers must be built, power systems must be expanded, materials must be sourced and processed. We are not at the early concept stage, and we are not at a late cycle saturation. We are mid-cycle. Again, we are not at peak, and this matters because mid-cycle is where durable infrastructure opportunities emerge, especially in systems that cannot scale quickly. Most public attention remains on software and models, but constraints exist deeper in the system. Physical bottlenecks shape the pace of AI expansion. Power availability determines where data centers can be built. Compute access determines who can deploy at scale. Materials determine how fast systems can expand. Bottlenecks do not stop adoption. They extend timelines and investment cycles. Scarcity shifts value toward enabling systems. Electricity demand is emerging as the primary constraint for AI. AI workloads are materially more power-intensive than traditional computing. According to the International Energy Agency, data center electricity consumption is projected to more than double by 2030. To put that into perspective, there are only 11 cities in the United States with over 1 million people. The CapEx buildout already forecasted to be built by 2030 is the equivalent of the U.S. economy building another 21 million person cities. These facilities require dense, continuous, high-reliability power. Power availability is becoming a gating factor. In many regions, access matters more than price. Grid expansion, generation, and transmission take years. This is not a short-term imbalance. It is a structural constraint shaping where and how AI can scale. AI compute is not a commodity resource. High-performance compute is scarce and difficult to replicate. Capacity is concentrated among a relatively small number of global operators. These operators control the infrastructure required to train and deploy advanced models. Access to compute is uneven. Not every firm, platform, or region can scale on demand. That concentration shapes who can participate meaningfully in AI development. Compute ownership influences pricing, utilization, strategic leverage. As demand rises, capacity constraints become more pronounced. This creates durable advantages for providers of compute infrastructure and competitive pressure for everyone else competing for access. AI infrastructure is hardware intensive. Hardware depends on physical materials. Electrification requires copper for transmission and wiring, steel and aluminum for data centers and build-out. Semiconductor manufacturing requires specialized inputs. Critical materials are finite and slow to expand. Supply chains take years to develop. Material constraints reinforce long-duration cycles. Infrastructure cannot be built on demand. Physical systems require planning, approval, and sequencing. Permitting alone can take years. Financing is deliberate and often staged. Construction timelines are measured in multi-year phases, and capital does not deploy all at once. It flows sequentially as projects move from concept to completion. This inherently slows the pace of supply expansion. At the same time, demand for AI-enabled capacity is accelerating. Adoption is moving faster than the systems required to support it. That imbalance between fast demand and slow supply extends investment cycles longer than expected. These environments tend to favor businesses that operate in capital-intensive markets with high barriers to entry. Duration matters. Cycles driven by physical constraints typically persist well beyond initial expectations. Alpha AI is designed to express the infrastructure thesis behind artificial intelligence. It translates structural insights into a diversified portfolio framework. The strategy focuses on the systems that enable AI to function and scale in the modern economy, specifically power, compute, and material capacity. These systems sit beneath every AI application and platform, regardless of which technology or interfaces ultimately dominate. Rather than attempting to predict application winners, the strategy emphasizes exposure to shared dependencies. This approach prioritizes structural exposure over tactical positioning, and it is designed for long-term participation in the AI cycle. The objective is to participate in durable, capacity-driven trends while avoiding reliance on short-term innovation outcomes. Examples of companies enabling AI infrastructure exposures span compute, power, and materials. These businesses operate in capital-intensive markets. Utilization increases as demand grows. Investment cycles extend over years. Structure is going to matter more than the individual holdings, but the segmentation and diversification will matter. This is how we distribute exposure across sleeves like compute, semiconductors, utilities, nuclear, uranium, midstream, copper, lithium, rare earth, and liquidity sleeves. Each pillar carries different timelines and risks. Exact weights are not the takeaway. Balance across constraints is critical, designed to reduce single-point dependence. The growth of the portfolio over the last number of years illustrates long-term participation in a theme. Infrastructure strategies are not linear. Volatility is expected during build phases. Drawdowns occur before capacity comes online, and focus is on long-term compounding. Time and patience matter. Alpha AI is built within MLD's established investment framework. It is not a standalone or experimental strategy. The same research and discipline used across MLD strategies is applied here. Portfolio construction follows the same standards around diversification, sizing, and risk balance. Exposure here is intentional, not thematic for its own sake. Risk oversight and governance remain unchanged, and the strategy operates within our broader risk management structure. There is no separate process. There is no shortcut. The difference is the theme, not the discipline. And accountability remains central. Decisions are evaluated across full market cycles, not short-term outcomes. Guys, this is designed for long-term investors that are comfortable with volatility. You have to be. Infrastructure timelines matter. This is best suited for a structural exposure to the AI build-out theme that we see over the next number of years. We are not looking for short-term outcomes, and our alignment of expectations is essential of how we approach this. The next step is a conversation. This is designed to assess alignment and fit if this works for you. This is not appropriate for every investor. That selectivity is intentional, and the structure and minimums we will discuss with you one-on-one.